The recent resurgence of inflation has once again thrust into the spotlight the ongoing debate regarding the optimal inflation rate, particularly against the backdrop of the Federal Reserve's steadfast commitment to a 2% target. Despite this, economists and policymakers, echoing the sentiments of notable figures like Milton Friedman, continue to question whether targeting zero inflation might offer a more prudent economic approach. However, delving deeper into the rationale behind the Fed's adherence to the 2% target and the subtle yet significant implications of maintaining this seemingly moderate threshold reveals a complex interplay of economic dynamics that warrants further scrutiny. While the Federal Reserve justifies its 2% inflation target by citing its role in providing a buffer against economic downturns, critics argue that this perspective overlooks the nuanced repercussions of sustained inflation. Notably, the insidious erosion of purchasing power over time due to even modest inflation rates can significantly impact individuals' savings, distorting economic behaviors by disincentivizing saving in favor of spending. Furthermore, the inflation-induced reduction in the real value of government debt presents a less overt form of default, subtly transferring wealth from creditors to debtors while evading the political fallout of a traditional default scenario. As such, a deeper examination of the implications of the Fed's inflation target underscores the importance of re-evaluating monetary policy frameworks and considering alternative approaches to address the broader economic ramifications of inflation. The illusion of price stability perpetuated by a 2% inflation rate belies the hidden consequences that gradually unfold over time. The erosion of purchasing power, compounded over the span of a typical lifespan, paints a stark picture of the detrimental impact of inflation on savings and investments, with the dollar losing a significant 75% of its value. Moreover, inflation serves as a subtle deterrent to saving, imposing an imperceptible tax on savers and skewing consumer behavior towards spending, thereby complicating economic decision-making and resource allocation. Furthermore, while the Federal Reserve justifies its 2% inflation target as a safeguard against economic downturns, critics argue that this approach fails to account for the broader implications of sustained inflation. The gradual diminishment of the real value of government debt through inflation operates as a covert default mechanism, silently redistributing wealth from creditors to debtors. This obscure default mechanism underscores the need for a comprehensive re-evaluation of monetary policy frameworks, as well as the exploration of alternative approaches to address the multifaceted challenges posed by inflation in the modern economic landscape. The Federal Reserve's steadfast defense of its 2% inflation target as a safeguard against economic downturns is met with skepticism due to several inherent limitations. Chief among these is the ineffectiveness of negative interest rates in achieving the intended economic stimulus. Contrary to theoretical expectations, real-world data suggests that negative interest rates often fail to spur spending and investment, instead exacerbating deflationary pressures and prompting heightened saving behavior among consumers. Furthermore, the Fed's reliance on the wealth effect as a justification for its monetary policy stance lacks empirical support, as the purported link between rising asset values and increased consumer spending fails to adequately counteract the adverse effects of inflation on consumer behavior. Moreover, as interest rates approach zero, the efficacy of further rate cuts becomes increasingly questionable, raising concerns about the Federal Reserve's ability to effectively manage future economic challenges. Critics argue that the true agenda behind the Fed's inflation target lies in its role as a mechanism for diluting the national debt. By steadily eroding the real value of government debt through inflation, the Federal Reserve effectively orchestrates a silent redistribution of wealth from creditors to debtors, thereby avoiding the political fallout of a traditional default scenario. This nuanced perspective underscores the need for a comprehensive reassessment of monetary policy frameworks and a more transparent discourse surrounding the broader implications of inflation targeting. Critics contend that the Federal Reserve's purported aim extends beyond merely ensuring economic flexibility to encompass a more clandestine objective: the gradual erosion of the real value of government debt through inflation. Unlike a traditional default scenario, where the ramifications are overt and politically charged, inflation serves as a subtler mechanism for diluting the burden of debt over time. By deliberately maintaining a positive inflation rate, the Fed effectively orchestrates a form of implicit default, quietly redistributing wealth from creditors to debtors while avoiding the public scrutiny and backlash associated with a technical default. The implications of this strategy extend far beyond the realm of monetary policy, reverberating throughout the broader economic landscape. While inflation may offer a temporary reprieve by alleviating the immediate pressure of servicing a burgeoning national debt, its long-term consequences are cause for concern. The erosion of the real value of savings and investments undermines the financial well-being of individuals and exacerbates income inequality, while the distortion of economic incentives and behaviors complicates resource allocation and undermines long-term economic stability. As such, a comprehensive reassessment of monetary policy frameworks and a more transparent discourse surrounding the implications of inflation targeting are imperative to address the multifaceted challenges posed by the Federal Reserve's inflation objectives. Addressing the deleterious effects of inflation presents not only political challenges, but also the imperative to recognize and confront the broader implications of such policies. Advocating for sound monetary policy, characterized by stable purchasing power, is indispensable for fostering fairness, predictability, and prudent economic decision-making. While inflation may provide a temporary solution to mitigate the burden of unsustainable government debt, relying solely on this approach poses significant long-term consequences. It is crucial to address the root causes of excessive debt through decisive action and prudent fiscal management. Moreover, exploring alternative policy frameworks, such as reassessing the Federal Reserve's mandate and emphasizing saving as a fundamental economic behavior, warrants serious consideration to ensure sustained economic stability and prosperity. Understanding the complex interplay between inflation policies and broader economic implications is essential for policymakers and economists alike. By prioritizing sound monetary principles and addressing unsustainable debt levels through proactive fiscal measures, governments can pave the way for a resilient and prosperous economic future. Exploring alternative policy frameworks and fostering a culture of saving are crucial steps toward achieving long-term economic stability and ensuring the well-being of future generations. The nuanced consequences of apparently benign economic policies, such as the maintenance of a 2% inflation target, serve as poignant reminders of the profound and lasting effects of policy decisions on a nation's economic path. As policymakers and economists contend with the intricacies of monetary policy, it becomes increasingly imperative to grasp the hidden costs and broader economic implications of inflation. A comprehensive understanding of these factors is vital for effectively navigating the complexities of an ever-evolving economic landscape. By placing emphasis on sound monetary principles, addressing unsustainable levels of debt through proactive measures, and exploring alternative policy frameworks, policymakers have the opportunity to establish the groundwork for a resilient and prosperous economic future. Moreover, recognizing the multifaceted nature of economic challenges and the need for innovative solutions is paramount. Policymakers must remain vigilant in their pursuit of policies that promote stability, fairness, and sustainable growth. This entails not only re-evaluating existing frameworks, but also fostering a culture of adaptability and resilience in response to emerging economic dynamics. By embracing these principles and taking decisive action, policymakers can steer economies towards greater prosperity and resilience in the face of an ever-changing global landscape.